FuboTV.com.
24 seconds away from the opening bell in New York City this morning. Good morning to you all. We've waited 40 years to see a 7-handle on inflation in America. The market's been waiting several months for it. Equity futures up 0.4% on the S&P. Coming out the other side of the print, the Nasdaq outperforms, up 0.7% on the Nasdaq 100. There's the opening bell. Switch up the board and go into the bond market. A move of more than 20 basis points year to date on 10s. Coming out of the print a little bit lower, down 2 to 171.63. In the FX market, the euro reclaiming a 114 handle at 114.11. That currency pair up 0.4%. And crude still flying high. WTI staring down 82 at 81.84, up 0.75%. So around the open then, about 20 seconds in, the S&P 500 advancing 0.1%. The underperformance coming from the more defensive parts of the equity market, utilities and healthcare. Top of the pile, IT, as you might expect, given where Nasdaq futures are. Information technology up by 0.8%. Consumer discretionary up by 0.75%. Citi's Robert Buckland looking for a March dip in this equity market. Here's what he had to say.
The kind of sell-off that we've seen in the first 3, 4, 5 days of this year doesn't count as a dip to me. I'm thinking about something more like 10%. And yeah, fine, that's not a problem. But what we do know is that there is a major hurdle for all financial markets to deal with potentially in March of this year, which is the first upturn in the US rate cycle for 6 years. I suspect that's where perhaps the proper dip will happen.
We started to talk about buying the dip. The first thing that Rob Buckland turned around and said was, where's the dip? Emily Rowland, Jack Caffrey, Vishy Tripatur. Emily, let's go there. You've talked about these difficulties in the second half of this year. Why the second half and not what we're facing right now?
Well, look, right now we still have a pretty awesome economic growth backdrop. Manufacturing PMIs in the U.S. around 58. That's very much expansionary. We have a Q4 earnings season that's penciled in to come in at 21% year over year. That's great as far as the fundamental backdrop goes. I think it just gets a little harder into next year. We look at earnings growth for the S&P 500. It's in the mid-single digits for the first 2 quarters of 2022. Still fine, but we're leaving sort of the earnings nirvana of 2021 where we saw 45% earnings growth in the S&P 500. We're also looking at a Fed that's tightening into a slowing growth backdrop. To us, that means you want to stay positioned for now for this accelerating growth backdrop, but you want to look at getting incrementally more defensive as the Fed continues down this path of tightening. There will be a fork in the road where investors need to decide, are they going to keep adding to risk assets here, or are they going to start to look for more defensive parts of the market? And as areas like quality start to cheapen up, as the year progresses, that's where we're going to be looking to add into the end of the year.
Well, many are adding right now at 47.41 on the S&P 500, up 0.6%. On the Nasdaq again, up 0.9%, a lift this morning. Vishy, Jack Caffrey's looking to your world for signs of distress in credit. Vishy, I promised I'd come to you on that. Do you see any signs of that?
Not really. I think if you start looking at, you want to distinguish between fundamentals and technicals. Right? The fundamentals are fine. On the other hand, the credit markets really did benefit a lot from the amount of liquidity that the Fed injected into the markets through quantitative easing. And in fact, last year is a prime example of this. In a year where the total returns were actually negative, we saw pretty massive flows into credit markets. So the part of the credit markets that's actually most sensitive to this part is the investment grade part of the credit market. So fundamentals are fine, and by any metric, liquidity buffers, debt service ratios, all of those things, fundamentals are fine, but the sensitivity is more to this withdrawal of liquidity in the market, and that hits the investment grade market more than it hits the high yield markets. So our thinking is there is still opportunity in credit, and the opportunity is more in high yield versus investment grade. And within high yield, we think there is better opportunity in leveraged loans versus high yield bonds. So the way I would think about ordering, sequencing of this is leveraged loans over high yield bonds over investment grade.
And the rate story backing up that story too. Jack Caffrey, how much comfort does that bring you?
Well, I would clarify what I had said in that when I look to fixed income, I don't think we have a credit cycle that we have to worry about in terms of distress. I just do want to keep seeing credit investors still happily taking down the size of credit offerings that we've seen, or corporate credit offerings that we've seen over the past year and a half. That appetite to continue taking risk, I think, in credit will be, I think, telling and telling for the equity market. But coming back to this, I do think in this environment of decelerating growth and possibly decelerating inflation, I think investors are going to feel, looking at much tougher comparisons, I think they are going to start focusing a little less on deeply cyclical ideas. We talked about the airlines a few minutes ago, and start thinking more about those businesses that have quality, have some ability to control their pricing, perhaps because of what they offer uniquely rather than necessarily relying on short-term supply-demand dynamics. And I think that will become what investors can own for the next several years rather than for the next several months.
The other question,
comes back to emphasizing quality. Sorry.
The other question I hear a lot, Jack, and just to jump in because I wanted to get there, and I'm being a bit unfair here because I'm going to quote your colleague, Bob Michael at JP Morgan Asset Management, is if this market gets into trouble, when would the Fed back off and what is trouble? And Bob said we disagree about where this Fed put is. It's not 2 to 3%. He thinks it's 15 to 30% lower, given the dynamic we're seeing in the market at the moment. Now, obviously at JP Morgan Asset Management, everyone has their own view on things. We have different portfolio managers, Jack, so you're allowed to take a different view on this. I just wonder from your perspective personally, what you think that Fed put looks like with this backdrop we have at the moment, with a 7 handle on CPI.
It's probably going to have a much lower strike price than it's had over the past several years. And I think they can look to a much more robust growth environment than they had in the last cycle. The last cycle was characterized by what felt like the terrible twos that ultimately became the terrific twos and created non-inflationary growth. If you have an economy that can post 4 or 4.5% growth in the real economy, I think ultimately that gives the Fed a little bit more wiggle room around sell-offs. And are sell-offs at the market level, or are they more vertical level? We've certainly seen a massive sell-off, say, in high-growth software, and that certainly is not changing any bits of the Fed's commentary. So I think the characterization of a sell-off before actually seeing it is hard to speak to, but I do think that you're not going to have the rush to remain calm sort of speeches that we've gotten out of the Fed over the last several years because the operating environment gives them more flexibility.
Jack Caffrey, well put. So divided on that debate, though, right now for a lot of people I know, and that really shapes your view going out 12 months at the moment. About 7 minutes into the session, equities up 1/3 of 1%, the Nasdaq up 0.8. Yesterday, snapping a 5-day losing streak. Katie Lyons, this market coming out of that inflation print, doing okay.
Yeah, and continuing the rebound we saw taking shape yesterday, or really Monday when it comes to the NASDAQ 100, the big tech rebound in particular is what I want to focus on because we came in Monday off of the worst week for the NASDAQ 100 going all the way back to February of last year. The index fell as much as 2.7% before closing the day in positive territory, and those gains have continued in the next 2 sessions. Right now, we're up more than 5% from the lows of the week. And what has really seen the rotation we had seen at the start of the year turning back the other way in that when you look at this chart on GTV Go, we're looking at the NASDAQ 100 index's performance, which is obviously very tech heavy relative to the S&P 500 value index, basically expensive stocks versus cheaper ones. And what we have seen is 2 back-to-back days, now 3 of tech outperforming, which followed, of course, value leading 8 of the 9 days prior to Monday. That's why there's a lot of red downward pointing bars on the right-hand side of that chart. Now, the reason why this is, John, well, you can probably look to the bond market for that answer because, of course, we saw a massive move in the first trading week of the year, the 10-year yield moving up 25 basis points over just a 5-day period. That has calmed down a lot. And, of course, we're seeing yields coming in today off the back of that CPI print. So 1.72 or so % on the 10-year and moderating from where we were at the end of last week, maybe a little bit easier for investors in some of those high multiple stocks to swallow.
Katie, thank you. The big banks, the big winner off the bond market story that Katie's been talking about, up almost 10% year to date. On Friday, we kick off earnings season with JP Morgan. BNY Mellon's Alicia Levine weighing in.
The theme of the equity market this year is going to be earnings. I feel comfortable saying for the first half of the year, we do think financials can outperform. You want to own the banks that lend because we see that corporate loans are actually increasing, CapEx loans are increasing. Consumers, for the most part, have spent down the extra savings that they had. So we see credit card debt increasing. And so the banks that lend should do relatively better.
On the story, here's Abby.
An interesting point Alicia Levine is making on banks and lending. We'll get to that in a moment, but they do kick off. The earnings season for big banks kicks off on Friday with JP Morgan along with Citigroup and Wells Fargo. A little bit unusual perhaps on a Friday ahead of a long holiday weekend. Next Wednesday, we will have Goldman report, and then on Tuesday, Goldman reports, and on Wednesday, Bank of America and Morgan Stanley report. Now, relative to net income, JP Morgan is expected to lead the pack, nearly $9 billion in net income. That represents 30% year-over-year growth. Bank of America is expected to come in closer to $6.4 billion, and then the rest of the pack somewhere between $3.2 and $4.2 billion. Now, on the year, as you were mentioning, John, the banks are up in a huge way. Today, a bit mixed, even down. That may have to do with Jefferies. Jefferies reported today, sometimes seen as a harbinger of what's to come at their larger rivals. Not a great quarter. Revenues down on a year-over-year basis. Investment banking up just 5%. Capital markets fell 30% on fixed income. However, that potential bright spot that Alicia Levine was speaking about, the big money center banks, loan growth. The Fed data does point to strong growth, up 3.5% at the end of December. So that could help out those banks. On the other hand, John, of course, bringing in the wage conversation, everybody will be watching wage inflation and expenses for these big banks. How much will they have to pay up to keep the big talent?
Abby, thank you. A final word now on the earnings. Looking ahead with Emily Rowland, Jack Caffrey and Vishy Tirupattur. Emily, first to you. A final word, please, on the earnings to come.
Yeah, as I mentioned, Q4 earnings estimates up over 20% is what we have penciled in. That should be great. Actually, financials, though, the only sector expected to see slightly negative earnings growth in Q4. Certainly, we do agree with Alicia that loan growth should be supportive of the banks. We just don't see those organic drivers that should help the sector as much as we do in areas like technology into next year. So we want to own those sectors that have great balance sheets, good return on equity, ability to maintain margins, and ability to grow organically, even as the economic backdrop starts to normalize into this year.
Jack Caffrey.
I think that the key issue is that we're seeing really the end of the easy comps, easy comparisons on the earning front, and ultimately that shifts your attention towards businesses that have more control over their destiny rather than less. And I think, to come back to a theme that we talked about a bit earlier, the idea that there is going to be more pressure, more commentary out of Washington in terms of corporate greed, I think that actually is going to put a little bit more pressure on the idea of companies being able to grow inorganically. And so that emphasis shifts back to companies much more in control of their destiny, either through innovation, their own designs, or the sale of a particularly unique product rather than I can go out and buy capacity in the current environment.
Very interesting point. Vishy Tirupattur, final word, sir.
So let me invoke my equity strategy colleague, Michael Wilson, on this. He expects to see earnings growth to be pretty solid. The bigger challenge in the market is not in terms of earnings growth, but in terms of the PE multiples. So a strong earnings growth through the year, but a much more challenged environment for PEs, the PE ratios coming down, and that is the rationale for Mike Wilson to be less than constructive on equities.
The 4,400 call at Morgan Stanley. Vishy, awesome as always. Great to catch up with you, sir. Vishy Tirupattur, Jack Caffrey, Emily Rowland, thank you to all three of you. Your equity market up 1/3% on the S&P. On the NASDAQ up 0.6%. Crude doing nicely. WTI 82.30. Coming up, crude prices climbing to a 2-month high.
Events outside of the core fundamentals of oil impacting crude this year is going to be hugely important.
That conversation up next. This is Bloomberg.
Read carefully.
This is Bloomberg's The Open. I'm Katie Greifeld. You're looking at a live shot of the principal room. Coming up on Balance of Power, Kay Bailey Hutchison, former U.S. NATO ambassador. That's 12:40 p.m. in New York, 5:40 p.m. in London. This is Bloomberg.
We still think triple-digit oil is within the works heading into the second quarter. We see demand recovering quite meaningfully, and one thing we've been noting for a while is that OPEC plus supply is likely going to start leveling off in the next 2 months.
Oil climbing to its highest level since November, with demand making a comeback. Oman's oil minister expecting OPEC supply hikes to remain conservative, saying the following: demand is increasing and we want to make sure that the market is not overheating. We don't want to see $100 a barrel. The world is not ready for that. Joining us now is Bloomberg's Julian Lee. Julian, what is the case for triple-digit crude?
We are already seeing a much tighter market than people were forecasting in the first quarter. The U.S. Energy Information Administration is now for the first time seeing stockpiles globally drawing in this quarter. Everybody up until now is being forecasting that they would start to grow again. We've seen the International Energy Agency saying similar, that the market is tighter than people had assumed. Basically, Omicron hasn't had as big an impact on demand as people had feared, and at the same time the OPEC plus group aren't producing in line with their targets. They're about 600,000 barrels a day shy of that at the moment, and that gap is expected to get bigger as the year persists.
Julian Lee, your thoughts on whether we're in the sweet spot right now just for them in terms of prices? Do you think they're satisfied with Brent at 84, WTI at 82? Is that where they want things to be?
I think they're not unhappy with that level of prices. I mean, you know, if you talk to any of the ministers, they sort of shy away from talking about what sort of price they want. But we're certainly not hearing the sort of things that we used to hear in the past, with the right price of oil being $1 or $2 above where it is at the time of asking. They are much more concerned at the moment about balances and about levels of inventory. And I think seeing the market starting to look tighter than they had thought even a month ago is going to raise some alarm signals about the pace of increasing supply.
Julian Lee, as always, sir, thank you very much. This energy story, a big component in the conversation around inflation this morning, a 7-handle. That 7-handle, the headline inflation read, led by shelter and used cars. Energy costs actually turned lower in the last month. You wonder how that develops through the next couple of months with crude back into the 80s. Over in China, inflation actually cooling. The team at China Renaissance saying the following: the probability of a rate cut in the first quarter is high, and the closest window is this month. Consumer inflation will not be a concern in 22. Damien Sassower of Bloomberg Intelligence with us now. And Damien, it's a very different story, the numbers we saw overnight in China and the numbers we're seeing this morning in America.
Well, it's different but the same, Jonathan. I mean, look, U.S. CPI has historically tracked China PPI very, very strongly, certainly in recent years. And so this feeds into the transitory argument. Here in the U.S., you know, China PPI coming in at 10.3% year over year, down from an expected 11.3%. That's a pretty big miss. So, you know, it may feed into the fact that U.S. CPI is going to decline in the coming months, but forget about the inflation data in China. We really need to focus on the total social financing data. And for me, yes, we saw some stabilization, but if you look at China household medium and long-term loans, which is a proxy for mortgage lending in the sector, we know what's going on in the property sector in China, Jonathan. It shows the weakest rise since February of 2020, when basically China was shut off due to the pandemic. And if you look even further beneath the surface, shadow banking, shadow lending, an alternative method of funding corporate and government balance sheets, down for 11 straight months. So basically, yeah, I mean, shadow financing, there's nowhere for mortgage lenders to go, and this is feeding into some of the downgrades we've seen from Moody's and Fitch across the property sector, issues like Shimao and Yuso.
And the downgrade from Goldman on the general economy for GDP growth this year, that weakness concentrated in the first quarter. Damien, how do you think this data out overnight shapes the policy response still to come from the Chinese Communist Party?
I mean, it's going to be more easing. This feeds the fuel for more rate cuts ahead. I mean, we told you yesterday, 50 to 100 bips of triple R cuts are what we expect in full year 2022. I think it's front loaded. I think we're going to see that sooner rather than later now.
Damien, thank you, sir. as always, to get us up to speed on China and emerging markets as well more broadly. On the S&P 500, up 0.5%, about 21 minutes into the session. On the Nasdaq, up 5 or 0.6%. Breaking it down, your sector price action, as always, here's Kriti Gupta.
Yeah, John, good morning. You are seeing green on screen when it comes to the S&P 500. A lot of it thanks to having big tech on its side, finally actually driving the index higher. But on a sector basis, a little bit of a different story. Materials and industrials also towards the top. A lot of that has to do with the commodities rally you are seeing. The big message of the day, though, is that it is risk on, whether you look at the stock market or the commodities market. To the downside, though, healthcare, utilities, consumer staples, those are your laggards. Those yielding sectors are in the red. Healthcare in particular is the one that's weighing the index down, though. Biogen is going to be your big story. This coming after the U.S. government limited Medicare coverage of its Alzheimer's disease treatment and similar drugs to patients enrolled in clinical trials. Just take a look at what it's doing to the Nasdaq Biotech Index. Remember, biotech has been something that's really traded and taken the cue of big tech, but lately, in the last quarter, really, of 2021, actually impacted by Biogen's really controversial Alzheimer's treatments, simply not getting approved in Europe or Japan, but getting the nod here in the United States, John.
Kriti, thank you. With the equity breakdown there for you. In the bond market right now, 10's unchanged at 173 off the highs of the year after going in and through 180, on 2s through 90 briefly. Just south of that level, the 2-year coming in a couple of basis points. Not the inflation surprise that some of you were looking for, in line with expectations, a 7 handle. But that 7 handle is a sticker shock for the politicians out there. If this morning this isn't a big market story, it could be a big political one. Coming up on the program, we'll whip through the market events you need to be watching and get you to your trading diary as we work our way through the week. We still have retail sales still to come this Friday. From New York City, this is Bloomberg.
And get started today.
The bottom line is that Ed Hyman sees this economy growing 4.5% in 2022, and that for us translates into 11% earnings growth on the S&P 500, and that's the recipe for higher stock prices, period.
Fantastic to see a good friend of mine in this program, Julian Emanuel of BTIG, now Julian Emanuel of Evercore in a brand new seat, looking for 5,100 year-end on the S&P 500. On the S&P right now, up 0.5% at 47.38, a headline from the Saudi Wealth Fund just moments ago, and on the Bloomberg terminal, looking to invest $10 billion in stocks through the year ahead, through 2022. That's the equity market. Here's the bond market picture. You see the Nasdaq doing nicely there, yields in on a 10-year. 10 years right now, 173 on 2s, just a little bit higher, up a basis point to just short of 90 basis points. Will these moves stick after a morning where we saw 7% CPI? Let's get to the trading diary. You'll hear from the White House with a COVID response team leading a press conference at 11 Eastern. A ton of Fed speak through the week. You'll hear from Kashkari a little bit later. Tomorrow, Governor Brainerd facing her nomination hearing for Vice Chair. Claims on Thursday, retail sales on Friday, and we kick off earnings season with JP Morgan. Deep breath. What a morning. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Wednesday, January 12th. Here are the top market stories that we're following for you at this hour. Inflation hot like 1982. Prices see their biggest jump in nearly 40 years, with food, cars, and clothes all costing more. But investors shrug off the data. Equities rally, yields fall, markets close to pricing in a March rate hike from the Fed. Is inflation now fully priced? And private equity rakes in the cash. You got Blackstone collecting almost $9 billion for its latest credit fund. We're going to speak to Ali Satvad of KKR, which just raised $4 billion to invest in high-growth healthcare companies. From New York, I'm Alex Steele, my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, I wonder if it was sort of a sell the rumor, buy the fact situation when it comes to the market.
Yeah, the market has had a big move already this year, and to a certain extent, we still have yet to fully reverse the downside we saw in the NASDAQ. It's still down circa 2.5% year to date. Now, we're obviously not very far into the year, 12 days to be exact. So we've already seen a lot of action, and that action has come relatively quickly. So I think you are going to get quite a lot of gyration and rotation around these markets. But there is an interesting question to be sort of asked around all of this, which is basically, Alex, if we've got to the point where we're pricing in 4 hikes, i.e. in hot inflation fully priced, what comes next? Does the Fed get more hawkish? If we have fully priced in those kinds of moves, what does that mean for the growth value rotation? Does it start to pause, as many as are starting to suggest? Certainly that's the view coming out of Barclays. So let's talk about whether or not hot inflation is fully priced. Mike McKee, Bloomberg International Economics and Policy Correspondent, joining us, and Ira Jersey, Chief U.S. Rate Strategist for Bloomberg Intelligence. Ira, let me start with you. Is hot inflation now priced?
So yeah, I think it mostly is. If you look at what the inflation swaps market is pricing, so this is where the market thinks that CPI will be over the tenor of this particular instrument. If you look at that, we're thinking 4-ish% inflation this year, and then slowing inflation in 23 and 24. So the market, I think, is certainly pricing for a deceleration of inflation growth, but 4% inflation is still relatively high to what we've gotten used to over the past 2 decades. So I do think that at least in the rate side of things, the rates market is kind of there already, thinking that we're going to have continued inflation, well above 3%, which of course is well above the Fed's target.
All right, Mike, next question to you, same thing. Is hot inflation fully priced?
Well, I defer to Ira on the fully priced idea, but I would say that the Fed probably thinks it is at this point because we've not had any secret about the fact that the Fed is going to be raising rates. They've talked more and more about it as the weeks go on. It's more a question of what is the price? What is the appropriate price for each of the different tenors? And that's what the market is trying to figure out. Jay Powell noted that yesterday, talking about how the markets tend to, overreact and be somewhat volatile as they try to piece together where they should be on these things, because they haven't had, it's been 2.5 years since this round began, two years, and then we went for 7 or 8 years before that at zero rates. So what is the actual price? What is a 5-year note actually worth?
Mike, let's just talk about what the Fed's job is going to be going forward. We heard it articulated yesterday by the Fed chair, Jay Powell, up for renomination. He talked about the idea of being able to bring inflation down without sort of damaging the U.S. economy. That is a very tough needle to thread. In terms of the pricing on inflation, there is this kind of expectation, as Ira talked about, of inflation coming down. My question is, can it be brought down without damaging the economy? And if that is something that we now need to think about, is that the focus for markets going forward from here, rather than worrying about kind of where inflation is and the Fed reaction? It's what action we get from the Fed's moves in terms of the real economy.
Well, I think you'll see the Fed move very cautiously. Their track record in this area, not very good over the history of U.S. recessions. A lot of them have come about because the Fed over-tightened. But it reminds me of the old saying, it's better to be lucky than good. The Fed could do it this time without doing a whole lot if the reasons they think we are seeing this inflation are correct and they start to go away. If supply chains start to rationalize at the same time that consumers start to spend a little bit less, particularly on goods rather than services, because the government support they were getting has slowed down, then inflation could come back down. And could come back down noticeably, not necessarily to their 2% target, without them having to tighten too far. That's going to be the question, is the Fed going to have to do this, or is it going to be things that happen sort of organically?
Right. And in some ways, rents, for example, immune in some ways to both of those things. We'll break it down in a sec. Ira, if the scenario that we're sort of talking around here works out, that as inflation will peak and then slowly move lower, and that the Fed's not going to make an enormous policy mistake, where do you think we need to see the biggest re-rating in assets?
Yeah, well, I think for the rates market, I think that probably means we get a little bit of a steepening of the yield curve if the Fed does it correctly, right? So the risk here is that the Federal Reserve hikes too much, right, and too fast. And that goes to Guy's question from before, is if the Fed gets it wrong, like Mike noticed they often do, and go too fast too quickly, that's when you can get a significant flattening of the yield curve. That's probably when you see risk assets do pretty poorly, and then kind of forcing the Fed maybe to slow down their interest rate hikes. So I think there is a tough balancing act here. And as far as market repricing, like there's not a lot of markets right now that we see that are very out of whack in the fixed income space, except maybe the TIPS market a little bit. There's been a lot of people putting in tens of billions of dollars into TIPS products like ETFs and mutual funds in a market that's relatively illiquid compared to, say, the regular U.S. Treasury market. So you see real yields at negative 80 basis points for 10-year TIPS. That's way too low. And over time, I think that's where you can see a significant repricing as the Fed hikes and starts to run off their balance sheet, which seems like it's a done deal that the Fed is going to start doing that very soon after they initially hike.
Ira, how quickly?
Well, we think that the Fed's is going to hike in March, and probably May or July will be the months when the Fed will start their runoff. We think mid-year for runoff would be the right time because they can basically prep the market with 2 meetings and let us know how they're going to actually conduct their runoff in a significant way, plus get some feedback from investors and broker dealers. So I think July is when they start. We think that they'll start at a pace of around $90 billion of runoff a month, which would be a little bit slower than they were buying, but that's still a reasonably fast pace. So there will be, market repricing on that information. So things like the mortgage-backed securities market could see their spreads widen, which obviously will slow down the economy a little bit. If you have slightly higher mortgage interest rates, that would certainly have an effect on housing.
Well, considering we can't even really build all the houses that we're trying to build, that's definitely one thing. Hey, Mike, Powell made the point yesterday that all of this is just to get to neutral. It doesn't even count yet as tightening. What's the sequencing for actually tightening?
Well, that's a good question because they don't exactly know where neutral is. They're betting it's about 2.5%. And there's a great debate in the markets about whether you can get to 2.5%. They didn't when they were coming out of the great financial crisis. And there are some on the other side of that trade, like Larry Summers, who says they're going to have to go, well, even Bill Dudley yesterday saying they're going to have to go 3, 4, 5% before they get to neutral. We don't know what the demand side of this is going to turn out to be, and that's the problem for the Fed. So I think they're going to be very cautious. Bill Dudley makes a good point in a Bloomberg opinion article this morning that may sort of push back at what you were saying, Ira, about when they start the balance sheet runoff. He thinks that they want to get the Fed funds rate up to at least above 1% so that if things go pear-shaped, they can start cutting it again and not have to immediately start QE again. So it could be a little bit longer, faster than the 2 years before they started tapering or letting the runoff go last time, but a little bit a little bit slower than some people are anticipating. Then when they get above 1%, Alex, is the answer to your question, they start to look around. They start to see what is happening with the economy and what is happening with inflation.
All right.
Okay.
Guys, thanks a lot. Really appreciate Bloomberg's Michael McKee, Ira Jersey of Bloomberg Intelligence. Thank you very much. Really good roundtable conversation. We're going to continue that conversation as well with our next guest, saying U.S. monetary policy would need to be tighter than what's discounted. We'll break that down with Rebecca Patterson, Bridgewater Associates Director of Investment Research, joins us next. This is Bloomberg.
Download Thumbtack today.
If we see inflation persisting at high levels longer than expected, then we will, if we have to raise interest rates more over time, we will. We will use our tools to get inflation back.
That was Fed Chair Jay Powell speaking at his confirmation hearing at the Senate Banking Committee yesterday, which leads us to the question of the day. Is high inflation fully priced? It feels a little bit like sell the room or buy the news situation. Rebecca Patterson, Bridgewater Associates Director of Investment Research, is going to help us answer that question. Rebecca, is it fully priced?
No, it's definitely not fully priced. If you look at consensus today, it's got U.S. CPI going back to 2.3% by the end of the year next year. And obviously, 7% CPI, what we saw this morning, that's not likely to stick around. But even if inflation moderates, you have to think about the components. What are each of those doing? And two of the most important ones in our view, wages and housing, including rents. Those are going to be sticky, and they, in our view, have a lot of upside risk. So we think inflation is likely to be significantly above what's discounted and, of course, the Fed's target, unless they decide they're going to hike a lot more aggressively than what's priced.
Rebecca, good morning and Happy New Year. So how are you positioned for that?
Well, it comes down to, Happy New Year to you. It comes down to how much is the Fed going to tighten. If they want to get 2% inflation, their target, over a reasonable time frame, they're going to have to tighten more than it's expected. If they don't want to do that because they're worried about undermining the recovery, then they will still tighten, but they're not going to tighten as much as needed. So you have two possible outcomes, higher than expected inflation or more than expected tightening, and the amount of each you get is going to depend on exactly what the Fed does. So we're positioning for both. Because we can't read the Fed's mind, sadly. So we're looking for higher U.S. bond yields. I think the median forecast for the end of this year is around 2%. We think the bias of risk there is clearly higher. We're looking for inflation-sensitive assets like broad, diversified baskets of commodities to protect us against inflation. We're looking at equity markets that are going to be less sensitive to changes in liquidity if the Fed has to pull back liquidity faster than expected. And so we're trying to position for either of those outcomes in our portfolio.
So where does that leave you in tech? I mean, we've seen a lot of hedge funds in December start to sell some of their tech holdings, and clearly the last 8 days of this year have been quite tumultuous.
I mean, obviously, there's some longer-term supports under the tech sector. You've got tech CapEx, which continues to be very, very strong. You have buybacks, obviously, helping that sector. These companies are extremely cash-rich. But at the same time, to your point, you've got high valuations. You've got people extrapolating the growth of these companies going forward over the next decade. Some companies may hit that mark. They may meet expectations, but we think the bulk of them probably won't. So if you have that pricing, and now you have the Fed removing liquidity, these are very liquidity sensitive assets, long duration cash flows. And so they are going to be vulnerable in our view. The question is how much, given those offsetting supports I mentioned, but we think that is one reason that you want to look overseas with equities, places that are going to benefit from strong nominal global growth, less sensitive to the liquidity pullback, and probably offering much, much better valuations. Places like Japan, that would be a place we're looking at now in equities.
Is that value you're looking for? I'm assuming that it probably is. And if so, how much more does value have to go? Is this a trade? Is this a theme? Is this something that has legs?
Well, the value play, if you will, and I would say is going to be dependent to a degree on what goes on with the global economy this year. We think the U.S. is going to have nominal growth that's still very much above consensus expectations. And even with our high inflation expectation, real growth is still going to be quite a bit above potential. So the U.S. economy is moderating, but still quite strong. I think a big question to think about how far value can go is China. China obviously slowed a lot last year. And now we're seeing increasing, albeit more fine-tuned, easing steps to support growth. Can China get its economy back up to that 5.5% growth pace this year? I think if you had both of these big economic engines humming in 2022, that would make me a lot more confident that this cyclical leg or value leg, if you will, is going to have sustained legs. So I wouldn't just watch the U.S. I would keep an eye on China too, given its importance for all of these growth-sensitive stocks, growth in economic growth terms.
Yeah, there is a little bit of a narrative that since they saw their inflation data come down a little bit, they maybe did a little bit more room to ease there. Does that thesis extend to Europe? Because most individuals we talk to say if you're going to play the value trade, it's Europe over U.S. Do you buy into that?
Well, I think you do see a lot of investors who want a certain U.S. exposure just rotate within the market. So I don't necessarily think there's an exodus from the U.S. So I think you'll see a rotation within the U.S. But I also think Europe is pretty interesting right now. The European Central Bank, even though they're also seeing high inflation, so far seems more in the transitory camp. And they're likely to lag economic conditions there and let monetary policy stay quite easy. So different from the Fed. Fiscal stimulus there is continuing to roll out thanks to the EU recovery plan. And so that's another support for growth. If you also have a decent global backdrop, I think Europe is going to be a huge beneficiary of this combination of factors. So I do think there's some upside on European stocks. The recent years, we've really just seen these large luxury brands, the multinationals benefiting. I think this year the thing to look for is could you see that stimulus backdrop plus a little bit of an improvement in China and a still strong America help some of those domestic sectors as well.
Rebecca, pull this all together for me. What kind of rate of return do you think you're going to be penciling in at the end of the year?
Well, I think it's going to be a bumpier year when you consider that the Fed is going to be feeling its way a little bit. It knows it needs to tighten, but how much and in what shape? Is it rate hikes? Is it quantitative tightening? What is the data telling us? What's happening with the pandemic? I think that is going to create air pockets along the way. So we are going to see bouts of volatility this year because of the pandemic and how the Fed is going to navigate this. I think you want to make sure you're positioning for higher yields, either through the bond market itself or thinking about, okay, if I have a long-only portfolio, what assets are going to protect me against higher yields? Equity markets, I think, are still well supported, but some of those big measures of support, the fiscal, the monetary stimulus we had over the last 2 years, those are starting to fade. So I think you're going to be looking at lower equity returns this year. Seems like a pretty easy thing to say after the returns we got last year. I mean, one market I would look at if we do get, and again, this is where diversification is so important. You know, if China is in a different place in its cycle, we're all tightening, removing liquidity. They're adding liquidity to their market. They're trying to support growth. Yes, we've got the regulatory clampdown in China as they deepen their regulatory ecosystem, but you also have some really attractive valuations there and easing conditions. So being long Chinese bonds, looking for opportunities to be long Chinese equities, you know, there's a lot of differentiation in the global economy today. So even if returns overall for equities are lower, I think there's going to be some really interesting opportunities out there. You just have to dig around a bit.
Got to dig around a bit. Rebecca, it was great to catch up. We really appreciate your insights. Thank you so much for giving some of it to us. Rebecca Patterson of Bridgewater Associates, thank you very much indeed. What are we going to do next? We're warming up to the earnings season. Bank earnings start at the end of this week. We're going to talk about that next. This is Bloomberg.
Earnings season is coming.
Q4 earnings are going to be awesome.
Bloomberg is fastest with the numbers and analysis.
Amazon crossing the Bloomberg terminal. Where are investors seeing the weaknesses?
It means profits down the line. Earnings season on Bloomberg Television and Radio.
More in prospectus at Invesco.com.
23 minutes past the hour, the Nasdaq's up by 0.9%. Live from London, I'm Guy Johnson. Alex Steele is over in New York. This is Bloomberg Markets. Less pandemic-driven volatility, just starting to eat a little bit, Alex, into Jefferies' fixed income trading revenue. This was, to a certain extent, a little bit predictable. Shares falling on that fixed income slump. Let's talk about what this means, what it signals about the rest of the earnings season as well. We welcome, as ever, to talk about this subject, Sonali Basak. Sonali, walk me through the Jefferies numbers and what the takeaway is for the rest of the sector.
The biggest takeaway is that Wall Street has gotten very used to hitting records. So we're seeing Jefferies, which has been doing extraordinarily well in trading, finally see that slump in fixed income trading, and that jump in investment banking, which many banks are expecting, is not offsetting total revenue. So even with a 5% rise in investment banking, you have a 3% decline in total net revenue. So that is really the big question moving forward into the bank earnings. How much will some of these glowing businesses offset the declines in others?
And that chart is very stark because we kind of knew that this was going to come down. The trading revenue wasn't going to be the same as what we saw last year and in 2020, yet it still somehow is surprising the market. I wonder, how are we going to be set up into Friday?
Well, one interesting thing is what this means for consumer banks, because finally consumer businesses can shine a little harder. Credit card loan balances have gone up, as we've seen from Federal Reserve data, more than any other kind of lending in the most recent periods. So if you're a JP Morgan, if you're a Citigroup, that's very, very good news. There's some other trading businesses that can show some bright spots moving forward. Rates, for example, equities in the last quarter, so Goldman Sachs, Morgan Stanley, that could still be a bit of a bright spot. But guys, what I'm really interested in is these investment banking figures, because for some banks, we will see much bigger gains than other banks. It was such a competitive year in terms of M&A, in terms of financing, and so JP Morgan, Bank of America, Goldman Sachs should be big beneficiaries of that.
What does this year look like? We were just talking to Rebecca Patterson of Bridgewater. She talks about a bumpy year coming up. Is that going to further separate the pack?
You know, it's interesting. A lot of people have been talking about bonuses, but when I talk to executives, what they're also telling people as they're getting higher bonuses this year is don't expect this to continue, because there are a lot of concerns on the horizon, not just when it comes to inflation. We saw that print today, but a lot of the executives I speak to are still worried on the go-forward figures. So inflation, potentially choppier markets. People are very worried about geopolitical affairs as well, and what the rhetoric in Washington in a midterm year will look like. So with all of those things on the horizon, caution is really the name of the game, as well as rising interest rates here that could really start to eat into the story.
Sonali, really great stuff. Looking forward to all the coverage on Friday. Also, Bloomberg Sonali Basak joining us there. Coming up, you got cars and clothes driving U.S. CPI higher. We're going to take a look at those numbers and dive a lot deeper. What does it mean that services numbers weren't as high as some expected? Have they peaked, or is there more catch-up with goods prices? We'll break that down with the inflation expert, Omer Sharif, founder and president of Inflation Insights. On a day where you're looking at the bond market relatively calm, you're seeing a little bit of selling and underperformance in the long end, but the dollar index kind of dropping like a stone. This is Bloomberg. All right, we're about an hour into the U.S. trading session. On this Wednesday, Bloomberg Abigail Doolittle has more. Abigail, I've been looking at it all morning. Sort of, you sell the rumor, you buy the facts this time around.
Yeah, there is a lot of buying. In fact, for a second day in a row, the first time we've seen 2 up days for the S&P 500 in 2022, 3 up days for the NASDAQ 100. What's super interesting here is this Golden Dragon China Index up 1.6%, up along with the banks. So yields are down just a little bit after that. Inline CPI print, even though it's the highest since, I believe it was 40 years at 7%, but largely priced in. Fed Chair Jay Powell's comments yesterday largely priced in. On the year, we have both the S&P 500 and the NASDAQ 100 down. Interestingly, though, the HXC, or that China Tech Index, up on the year along with the bank. Sort of an interesting pairing there. Of course, the big driver for all of these indexes, yields. If we take a look at a year-to-date yield chart, the 10-year yield, we're going to see a massive backup, up 22 basis points. So a very big move in a short period of time. But over the last couple of days, sort of wandering down, so backing off a little bit, giving a little bit of relief around inflation fears along with valuation concerns for technology. Now, relative to Fed Chair Jay Powell's comments, what's more important, rates or the balance sheet? Well, obviously they're intricately tied in. However, this chart might suggest it has more to do with the balance sheet. In yellow, faintly, that's the 10-year yield. In blue, we are looking at the Fed's balance sheet, close to $8.8 trillion. In white, we're looking at the S&P 500. So you can see when the 10-year yield was going much higher last year, it really didn't do anything to the S&P 500, just following the balance sheet. Now, the balance sheet is still going higher at this time. The S&P 500 recently choppy. If you think of the S&P 500 as a forecasting tool, Guy, looking 6 months out, this chart may suggest that investors, stock traders, are a little bit more worried, again, understanding that they're connected, but a little bit more worried net about the balance sheet, the idea that it could shrink in the Q3, which I think was your point the other day.
Absolutely. We'll wait and see exactly what happens here. There seems to be quite a little bit of ambiguity around exactly what the timing and the pace of that is going to look like. The rate hikes, March looks increasingly nailed down. Abigail, thanks very much indeed. So let's get back to that inflation story. 1982, Eye of the Tiger, as Carl Riccadonna pointed out, was the big song in that year.
In my head all day.
We last had inflation this high. It's in everybody's head now, believe you me. Prices paid by U.S. consumers in December hitting a 4-decade high. That's, of course, a massive challenge for the President, Joe Biden, and a throwback, as I say, to the 1980s, when the then President Ronald Reagan battled inflation that was close to 9%.
It's a phenomenon that last year a majority of Americans correctly identified as our single most pressing long-term problem, inflation. Inflation and the high interest rates it leads to are the real culprits. They create the economic climate that leads to unemployment.
I want to be clear. I'm confident the Federal Reserve will act to achieve their dual goals of full employment at stable prices and make sure the price increases do not become entrenched over a long term with the independence that they need.
Volcker Powell. Start thinking about that one. The question of the day, of course, that we're working our way through is hot inflation now fully priced? Are we near a peak? How quickly does it come down? The base effect is going to kick in, but rents and other factors obviously could be a little bit more sticky. Omer Sharif, founder and president of Inflation Insights, joining us now to do just that. Give us some insight on inflation. Omer, great to see you. What did you make of today's numbers?
Yeah, so obviously largely as expected. You mentioned the story about the peak. I think we're probably right at the peak on headline inflation now, obviously incredibly high right now at 7%. But the core is probably going to move a little bit higher over the next few months. I see the peak probably in March of 2022 on core inflation. And then from there, I think we should see, as you mentioned, the base effect starting in April, a steady decline on that growth rate on inflation moving forward. The problem is just that we've had this huge run-up to such high levels right now that we're going to have a lot of wood to chop in the back half of 2022. I do just want to point out that there are a couple things that I think are sort of beneficial in terms of the inflation outlook, in terms of lower inflation moving forward. The most obvious is on used car prices. I mean, in the spring of 21, we were looking at 9-10% per month, and more recently that slowed to around 2.5%. Today was 3.5%. But the most recent high-frequency data suggests actually the next couple of months will be extremely soft on used car prices. So there is a little bit of sort of silver lining in some of the underlying data that we got today.
So then what do you make of rents? I mean, it's the biggest single portion of CPI. Okay, you're looking at used car prices, but I'm wondering how rents play into this and how that sort of maybe pushes off the peak a little bit.
Yeah, so, rents are moving pretty steadily, and so we are right around 0.4, and that's, just 40% of core inflation right there is just those two indexes. That's going to be a constant source of sort of upside for inflation moving forward. But, just to give you a little bit of quick math here. So right now we're looking at about, 3.2, 3.3% overall year over year in terms of rent growth. Let's say that moves up to close to 5% by the end of the year, which I think is quite likely. The amount that's going to add to core inflation, that's going to be much, much more than offset by sort of the decline that's expected in used vehicles by the balance of the year. So if you sort of net out the expectation for those two components in particular, you're talking about probably a drag on balance of core inflation of about a full percentage point by the end of the year. So yes, rents are rising. They're catching up to what we've been seeing in the private market rent data for 6 to 9 months now. But the expectation is that we should see the year-over-year change in used cars really sort of offset that, so that the overall impact net on inflation should actually be to push it lower.
In terms of wages, just give me a sense of what is happening there. We saw the earnings data today, and clearly wages are not keeping up. Does that start to flip? As headline inflation comes down, do wages stay higher, and does that negative number become a positive number? I'm just kind of wondering what could change here in terms of the ability for the consumer to keep spending and keep delivering on the demand side of the economy.
Yeah, so you're exactly right. Let's look at the ECI, which is probably the best measure of wage growth that we have. Private wages and salaries, real private wages and salaries, I should say, after netting out inflation, are actually falling year over year in most sectors outside of just a couple like leisure and hospitality, for example. So yes, inflation is eating away at these wage gains that people are seeing right now. And as you rightly pointed out, as we move on throughout the year, as inflation comes down, we should start to see those real wages pick up. But one thing in terms of the consumer continuing to sort of power consumption going forward is that they have been shifting away from sectors, as you would expect, where prices have been increasing to other sectors. So, a couple of examples, we've seen real spending on autos decline very, very sharply over the last 6 months. We've seen real spending on items like, I'm sure you guys have talked a lot about beef prices going up a lot over the last year. Beef consumption is down over 12% in the last 6 months as well. So you are seeing consumers sort of make these decisions to shift away from items that are seeing big price gains to other areas. So net, I think consumption should be okay, even though real wages right now are hurting because people are making those decisions to substitute away from higher priced items to cheaper items.
Omer, I want to direct your attention to a chart that we're going to have here that Guy had brought up earlier in our editorial meeting, and take a look at China PPI versus U.S. CPI. And the point is that China PPI is really about the input cost to the world, and that U.S. CPI is really the output cost to the world. And that you've seen China PPI, this blue line here, rolling over, definitely at its peak, whereas the CPI hasn't yet hit that, and you forecast for a few months. What is the correlation and the relationship that you notice between these two indicators, and how do we read those tea leaves?
So I'll be honest with you, I've been looking at this chart for years, and I'm just not a big fan of thinking that the China PPI has a great deal of information for the U.S. CPI. It definitely correlates much better with, for example, import price data and the U.S. PPI, but that flow through into what consumers are paying is actually not that strong. And really, it's sort of confined to a couple of items that we import a lot of from China. So, for example, the import share coming from China for apparel and footwear is incredibly high. So there's some pass-through there, but for most of the items that we're importing from China, there really tend to be more intermediate materials for manufacturing. So they don't really play a huge role for the U.S. consumer. So for me, I don't see a lot of sort of downside risk to inflation just because the China PPI is coming down, especially in light of the fact that, retailers today are paying more for transportation, for example, higher wages and so on. And those are some of the costs that could still make their way into what the consumer pays at the store. I don't think the China PPI really has a lot to do with anything in terms of the final price.
Right. On the flip side, you have the supply chain issues and sort of the zero tolerance COVID policy in China, which supports the other side of that. Omer, thanks a lot. We really appreciate it. We love talking to you on CPI Day. Omer Sharif, founder and president of Inflation Insights. And obviously, one part that we're really watching is what happens to energy prices. That's hot, particularly in Europe and here as well. So we have the latest oil inventory out. Super interesting numbers here.